Welcome back. Investing can seem intimidating, especially when you're just starting out. With the S&P 500 averaging around 9 to 12% over the past few decades, you might think it's a piece of cake. But the truth is, even seasoned investors, including professionals, often underperform the market. So, why do so many people struggle with investing? In this video, we'll explore the common pitfalls that investors fall for and how we can avoid them. By avoiding these common mistakes, we can become a top performing investor, even outdoing fund managers. What's really surprising is how poorly professionally managed investment funds do over any 15 or 20-year period. In fact, more than 90% underperform the S&P 500. And they are not much better over shorter periods either. Check these results out, which will be linked below. It's the latest SPIVA report, which stands for the S&P indices versus active scorecards. This report measures how many professionally managed funds beat the S&P 500. Unfortunately, the results aren't great for those that want to charge us a bunch of fees to manage our money. One of the main reasons they underperform the S&P 500 is that this study considers the fees they charge their customers. However, if someone recommended a front-loaded mutual fund to you, this study doesn't even include those fees, and they can be pretty hefty. It's hard not to wonder why we want to pay people to do worse. But do individuals fare any better when they manage their own money? Unfortunately, the answer is no. Dalbar's Quantitative Analysis of Investor Behavior report, which will be linked below, reveals some interesting findings on individually managed accounts. For instance, during the 3-year period ending in 2020, the S&P 500 averaged 15.27%, and the average individual investor averaged 11.5%, or 3.77% less. Even the average fixed income investor only averaged 1.08% over that period, but Barclays Aggregate Bond Index averaged 4.03%. And in the 10-year period ending in 2020, the S&P 500 averaged 13.56%. But the average individual investor averaged 9.43%, or 4.13% less. And that difference can be huge. Let's look at a 10-year period. $10,000 invested earning 13.56% would have grown into $35,666. But $10,000 invested at 9.43% would have grown into $24,624. That's a lost opportunity of an additional $11,042, or about 31% less. It's surprising that professionals and individual investors are doing so much worse than the market. Considering that we could have just bought the S&P 500 through a discount broker with no fees at all, and that ETF can have an expense ratio as low as 0.0003, which is so small it's really insignificant. Look at these returns for the S&P 500 over the past 10, 15, and 20-year periods. All of these include 2022, where the market was down 18%. And the 15 and 20-year periods also include the housing crisis of 2008. And as you can see, the results are still great. Now, let's delve into 2 fundamental areas that cause this underperformance. And if you stick around to the end, I'll wrap up the video with 10 important tips to help you become a better investor. First, investing can be fun, but if we're not careful, we can fall victim to the hype and hot tips. Let's call this first one the greater fool theory of investing. It's related to FOMO investing, or the fear of missing out, which is a behavioral weakness that can be so powerful when it comes to investing. In fact, Controlling FOMO is probably the most important financial skill these days, especially with social media bombarding us with investment advice. We've all seen the investment websites, industry experts, TV financial channels, maybe colleagues, and maybe even family members touting the latest can't-miss investment opportunity. We might even see our favorite athlete, celebrities, or social media influencer promoting these kinds of investments. It can all seem so tempting. After all, who wouldn't want to make some quick, easy cash? The problem is that when everyone is talking about it, the price is already inflated. We must resist these types of temptations. Have you ever seen headlines like these? These are actual headlines I've seen just recently. These kinds of headlines are nothing more than clickbait that are trying to sucker us into doing something stupid with our own money. When I was a child, one of my mother's favorite sayings was that a fool and their money is soon parted. That's what these remind me of. So, why did I call it the greater fool theory? Because it refers to an investor falling victim to FOMO, buying an overpriced asset without any regard to its fundamental value, on the belief that a greater fool will be willing to pay even more than you did in the near future. This is not investing. This is speculating or gambling. Investing done correctly should not be exciting or stressful. Done correctly, it's kind of boring. It just becomes a habit and something you incorporate into your monthly budget. Let's take a look at some recent examples where people chased an opportunity to make some fast cash. In 2022, during the Super Bowl, we had celebrities doing commercials telling us that FTX was a safe and easy way to get into cryptocurrencies. And then, just 9 months later, FTX collapsed and filed for bankruptcy. Thanks, celebrity. In October of 2021, when Bitcoin was trading at near all-time highs around $62,000, again, big-name celebrities started doing commercials touting crypto exchange, Crypto.com, as a safe and easy place to start buying cryptocurrencies. 1 year later, Bitcoin had fallen to around $20,000. Thanks, big-name celebrity. Even some of the best-known ETF funds can experience wild swings. During the year 2020, when, remember, there were some health concerns, that really inflated specific stocks. And the ARK Innovation Fund was in the news all the time. It had stocks in it that had amazing results, and that fund was up 153% during that year. But what happened then? Well, people saw that and they wanted some of that. And all kinds of new money invested into that fund. But during the next year of 2021, that fund lost 24%. And during the year 2022, it was down another 67%. Then there were all the cannabis stocks. Back in 2018, these stocks were in the news all the time, with celebrities getting involved, financial networks were touting them all the time, and more states were legalizing it on various levels. They were promoted as one of the new and hottest investment ideas out there. For many, it seemed like a can't-miss investment. Well, let's look back and see how they have fared. Canopy Growth, Aurora Cannabis, and Tilray are all down over 95% since then. For our last example, we have the meme stocks like AMC and GameStop. These two stocks skyrocketed in price during 2021, and then they collapsed. Some people got lucky and sold towards the top, but many people lost a bunch of money. You never know when you will be referred to as what's called the dumb money that came in too late, and it can really happen fast. If someone would have been unfortunate enough to buy GameStop at its all-time high, trading January 28, 2021, that investment would have dropped 88% in just 6 trading days. Again, when something crazy is going on, don't be a speculator or gambler with your money. Those are just a few of the many examples we could highlight. But investing is not gambling. We can also make a quick buck at a casino, but that's not sound advice if you want a secure financial future. In these cases, we were motivated by greed and the fear of missing out on a quick buck. The second thing to commit to our memory, we'll call this one less panic, and then we'll sell low and buy back higher. If you have ever been invested when the market is in a downturn, you know how stressful and uncertain it can feel. But emotions can lead us to do some pretty foolish things when investing. I remember back during the housing crisis, which began in 2007 and bottomed out in the spring of 2009. Talking with some of my fellow professors at the college, some of them were doing okay for a while as their retirement funds dropped, but eventually they became overwhelmed with stress and were constantly watching the news. Unfortunately, some of them eventually succumbed to the mindset that they just had to sell and hold on to whatever they had left. It was tough to watch, but emotions can often get the best of us. However, as we now know, the market eventually bounced back, and today in 2023, it's up over 500% from the bottom. In fact, just 5 years, the market was back to where it was before it all started. I wonder when they decided to get back in. Typically, when people panic in a bad market and sell, they are so unhappy and fearful of trying again that they often wait to get back in. Then, they watch the market continue to rise and finally want some of those gains, so they buy back in at a much higher price. Let's look at a graph of the S&P 500 for a minute. Look at that area around 2008, 2009. In hindsight, does it really look like something we should have panicked about and sold towards the bottom? But so many people panic during a downturn. And of course, when someone starts worrying, what do? They start watching and following the news all the time. What do news outlets do? Well, they sell panic and fear to freak people out, so they keep tuning back into the news. For instance, during the spring of 2020, when there was an illness that was scaring people, markets began to crash and many people panicked and sold. But the market ended up going up more than 18% that year. So just as we should not listen to those people hyping up stocks, we should tune out the noise when the markets start going down. In fact, if we would have invested $1,000 right before the housing crisis started in October of 2007, and then just ignored the news and did absolutely nothing, that $1,000 would have grown into over $3,600 as I make this video in 2023. That's a 260% increase. Just look at the performance of the S&P 500 over the past 10, 20, 30, and 40-year periods. As you can see, if investors had simply stayed invested and resisted the temptation to do something, they would have done quite well over any of those periods. So let's go over a few tips to remember so we can be a great investor. Number 1, invest for the long term. Avoid being a speculator and don't chase hot trends. 2, don't be an active trader. Invest passively with a hands-off approach through index funds and try to avoid being a stock picker. Remember that even professionals rarely succeed at trying to do that. Number 3, tune out all the noise in the media, especially when the market is going down. Number 4, don't try and time the market. Just save and invest each month using dollar cost averaging. 5, never borrow money to invest in stocks. Number 6, remember this motto: when the market is crappy, you should be happy. It gives you an opportunity to buy it when it's on sale for a while for the person that invests on a regular basis. So embrace the uncertainty. Number 7, focus on avoiding unnecessary fees. Remember that you can simply buy a low-cost ETF for the S&P 500 and you'll be in the top 10% of all fund managers. 8, don't invest money into the stock market that you will soon need. If there is a downturn, you don't want to have to sell and get your money out. 9, best thing you can do when everyone else is panicking about something that's in the news is nothing at all. You are invested for the long term. What the market is doing in any given year should be completely irrelevant. And 10, remember that investing should not be exciting and investment decisions should never involve emotions. If we control our emotions and avoid some of these silly things, we can be a better investor. Just simply buy and hold, take a longer term view, and realize that trading is not investing. If you have questions or comments about this, feel free to leave them below. Thank you for watching. Please hit the like button and subscribe for more videos.